Welcome to Deep Economic Thoughts with economist and best-selling author Ivan Elon. Once in a while, Ivan shares an unscripted, though potent, idea related to economics or the capital markets. This may be of interest to financial advisors and retail investors alike. Enjoy.
Greetings. This is Ivan Elon, the founder and chief investment officer at Aligned Wealth Advisors Investment Management, also known as AWAME. Thank you very much for joining me. Today is actually Wednesday, May 8th. You may be listening to this on another day, of course, but this will be the May episode. In this episode, I want to talk about the protracted yield curve inversion that we have seen essentially for the past 2 years. And what that means is that short-term interest rates, specifically if you look at, for example, the U.S. Treasury yields on short-term bonds coming due in 3 months, 6 months, 2 years, for example, those have been much higher. Those yields have been much higher than longer-term yields. Bonds coming due in 5 years, 7 years, 10 years, 15 years, 20 years, 30 years. And this is a problem. Anytime you have short-term interest rates being significantly higher, certainly significantly higher, it's a bigger problem. But just being higher in general, it's an issue. And we've seen this issue of short-term interest rates being higher over the past couple of years. We're coming up on essentially 2 years of this yield curve inversion. This is not normal. And actually, there's a companion graph to this podcast on our website at alignedwealth.com. That's ALIGNE wealth.com. And if you visit the website and go to the For Advisors tab and drop down to research highlights, you'll see this one was published on May 1st. And what you'll see there is a graph that actually compares two different histories, both going back to 1990. So covering essentially, over 34 years worth of yield curve shape, and whether it's been inverted or highly positive. And you can see the averages there. So essentially, there's two different yield curves that are looked at. The 5-year Treasury rate versus the 3-month Treasury rate. And there's a second one, the 10-year Treasury rate versus the 2-year Treasury rate. The 10-year versus the 2-year is probably the most popular comparison that's made when looking at or evaluating the shape of the yield curve and whether an inversion is taking place. However, there are times when you can actually see yield curve inversion occurring in different segments of the maturity spectrum. And so this analysis really just looks at the 5-year versus the 3-year, and then the 10-year versus the 2-year. And what's very interesting right off the bat that you end up seeing is that the average differential between the 5-year versus the 3-month, so you take the 5-year Treasury rate minus the 3-month Treasury rate, and you take the 10-year Treasury rate minus the 2-year Treasury rate, that will give you the differential. So if you look back all the way to January of 1990 and you draw a line through essentially all that data, you get an average of what that differential is. And so the differential has been almost identical, and that figure is 1.04. 1.044 for the 5 versus 3 month, and the 10 versus 2 is 1.04. 0.045. I mean, for all intents and purposes, we can call this essentially identical at 1.04, or 104 basis points difference between the 5-year rate and the 5-year Treasury rate and the 3-month Treasury rate. On average, the 5-year is typically 104 basis points higher than the 3-month Treasury rate. And the 10-year Treasury rate versus the 2-year is typically 104 basis points higher than the 2-year. The 10-year is 104 basis points, typically on average, higher than the 2-year. So this is a very interesting statistic in that these are completely different segments of the yield curve, looking at the 5 and the 3-month, looking at the 10-year and the 2-year, and yet on average, over very long periods of time, this is 3 decades worth of data, it's about 104 basis points of a differential between these two different segments. And what's even more interesting is if you compare the level of inversion currently between the 5-year and the 3-month, that's hovering currently at around 74 basis points of inversion, meaning that the 3-month Treasury is about 74 basis points higher than the 5-year Treasury. So this is, significantly inverted. And it was, by the way, just a little while ago, about a year ago, as much as 200 basis points inverted. So that's about 300 basis points away from average. That's quite significant. Looking at the 10-year versus the 2-year Treasury, currently the 2-year Treasury is yielding about 35 basis points more than the 10-year Treasury. And at its worst level of inversion around the same time as the 5 versus the 3-month, so about a year ago, was about 108 basis points. And so that's about 200 basis points away from average, its long-term average. So as it stands right now, the 3-month Treasury is significantly a significantly better place for an investor who wants to collect some nice yield. Of course, it's only for 3 months, but in 3 months you can be collecting significantly more yield than you could if you were committing to a 5-year rate of return. Similarly, a 2-year Treasury is paying 35 basis points more per year relative to a 10-year Treasury rate. Granted, it's only for 2 years that you're going to have that, essentially that guaranteed yield from the U.S. Treasury. U.S. Treasuries are considered risk-free rates because it's a very low chance that the government won't make good on its promise to pay the interest. And so this is a problem when short-term rates are as high as they are relative to long-term rates. It forces a behavioral change for an investor. What incentive does an investor have to allocate money into longer-term instruments or securities with longer maturities, when you can get very good rates of return with very, very short duration or very short maturities? Why take all that risk and all that uncertainty of what happens into the future when you can, essentially take a bird in the hand? Now, people will argue, okay, well, it's diversification and you don't know what rates are going to do in the future. Well, okay, but you do have a bird in the hand right now. And there's quite a bit of volatility that can still occur in the marketplace as things are adjusting to this higher interest rate regime that we're really now in. And the idea of going back to 1% interest rates or 2% interest rates for corporate debt, for example, or for government debt is, I think, more in the realm of fantasy than reality. And so how will we get back to a normal shaped yield curve, which we need? And the focus of my article this month for Forbes is exactly this question. We need an upward sloping yield curve in our interest rate markets to have a healthy economy. You need lenders to be incentivized to loan money out at longer periods of time and earn higher rates of reward for loaning out money for these longer periods of time. Otherwise, what's the incentive to loan money out for longer periods and earn less return than loaning out money for very short periods and earning more for that? So it's an illogical behavior. An investor, a lender, wants more reward given more risk. And anytime you have more time and longer time frames, longer maturities, it's inherently more risky because there's more uncertainty. There's many more things that can happen over those longer periods of time. And so when you lock money up into a certain term structure or a certain deal, a certain guarantee of rates or a certain promise of rates, that's what it is. So why would you do that if you know for very short periods of time you can actually earn more money? And this is the crux of the dysfunction in our capital markets today, certainly in the U.S. It's at extreme levels with this yield curve inversion that has been prolonged as it has been ever in modern history. And that's the other thing you really appreciate in looking at it graphically. And so if you visit the website to look at it graphically, you'll see this really protracted period of time of inversion across these different segments of the yield curve. And this is just looking at the risk-free investment of a U.S. Treasury bond. This isn't looking at corporate bonds. This isn't looking at high-yield junk bonds. This is just looking at the most boring part of our bond markets, which is the U.S. Treasury market, and to see this amount of inversion for this period of time really begs the question, how are we ever going to get back to this longer term average of 104 basis points? How are we getting back there? And what will happen to the fixed income markets as we do get back to that average, as we do get an upward sloping yield curve? Does this mean longer term rates are going to be skyrocketing, or is it more likely that short term rates will plummet? Certainly my thesis, and the thesis we have in our investment committee at our firm, is that short term rates are more likely to plummet, and not from Federal Reserve action or open market activity from the Federal Reserve, but more as a defensive maneuver from equity investors as a flight to quality or flight to safety, and driving a tremendous amount of buying demand within the Treasury market, thereby driving up prices and yields down. This, of course, is an idea and a forecast, not something that is a high level of predictability in playing out. But when looking throughout history in how yield curve inversions write themselves, that writing of the yield curve is typically done through the reevaluation and repricing of short-term bonds. And so we may very well find ourselves in a similar market environment yet again. I've gone a little bit longer than I usually have, but please, if you have any questions, don't hesitate to reach out. You can email us at info@alignedwealthllc.com. That's info, INFO, at ALI gnewealthllc.com. And we'd be happy to answer any questions you may have or submit questions that we may consider for a future podcast. I hope you have a wonderful month and look forward to sharing some insights and perspectives with you next month. Until then, take care.
For more deep thoughts, please subscribe to this podcast. Also, please feel free to visit www.ivanilorn.com to submit questions or topics through the contact page. Until next time, keep thinking deeply.